What if economic crashes aren't accidents, but features built directly into the system itself? What if recessions, depressions, and market meltdowns aren't failures, but part of a design that quietly transfers wealth from the many to the few? Because every time the economy collapses, we are told it was unpredictable, bad luck, or market forces, yet somehow the smartest bankers, governments, and financial experts on Earth keep accidentally crashing the system over and over for centuries. And at some point, coincidence starts to look like engineering. So, to understand this, we have to go back to the birth of modern money, where most people assume governments create money, but in reality, nearly all money is created by private banks through lending, meaning money isn't printed first, but borrowed first. Because when you take a loan, the bank doesn't hand you existing money but simply types new numbers into your account, creating brand new money out of nothing while attaching debt and interest to it, which means money only exists because someone owes something. And this leads to the first hidden truth, that if money is created as debt, then the system can only survive if debt keeps growing forever. Yet infinite debt in a finite world is impossible, so cracks are inevitable. And those cracks were baked in from the very beginning through fractional reserve banking, where banks realized depositors rarely withdrew everything at once, so they began lending the same money multiple times, turning $1 into 10 and 10 into 100, multiplying money faster than real goods or productivity could grow, creating the illusion of prosperity. And governments loved this because it boosted spending, while banks loved it because loans produced interest, but every loan carries interest that was never created in the first place, meaning there is always more debt owed than money available to repay it, which mathematically guarantees that someone must default, someone must go bankrupt, and someone must lose their assets. So failure isn't a glitch, but a requirement. And during boom times, everything looks healthy as credit flows, stock markets soar, houses rise in price, people feel wealthier, and businesses expand. But this wealth is built on leverage, not savings, on borrowed money, not real production, stacking debt on debt like a fragile glass tower. And because banks earn profits from interest, they constantly push more borrowing, which inflates bubbles in housing, stocks, and technology, until the tower grows too tall, and confidence finally breaks. Maybe interest rates rise, or borrowers miss payments, or one major institution collapses, and suddenly lending freezes and money seems to disappear. Because most money only existed as loans, and when loans die, the money vanishes with them, causing businesses to fail, jobs to disappear, families to lose homes, and fear to spread. Yet strangely, the biggest banks rarely collapse because governments rush in with bailouts using public money to save the same institutions that created the mess, turning private losses into public debt. And after each crash, assets become cheap, while ordinary people are broke. But the financial elite who receive bailouts have cash ready to buy everything at discount prices. So they purchase foreclosed homes, bankrupt companies, and crashed stocks. And when recovery begins, they own more of the economy than before, meaning every crisis concentrates wealth upward, every collapse strengthens the powerful, and every recession quietly transfers ownership from workers to which raises the uncomfortable possibility that these crashes aren't failures at all, but mechanisms. And although politicians promised reforms and regulations, the core system never changes, because endless debt creation is too profitable to stop. So, instead, they lower rates, print more money, and inflate even bigger bubbles that guarantee an even larger crash later, repeating the same cycle of growth, bubble, collapse, consolidation, and repeat like clockwork. And today, global debt has exploded to historic levels, while wages stagnate and asset prices disconnect from reality, mirroring the patterns seen before every major crisis in history, except now the scale is global, meaning the next downturn won't be local but systemic. And the monetary secret hiding in plain sight is that collapse isn't accidental but mathematically inevitable in a debt-based system, serving as the reset that clears weak players and transfers assets to those closest to the money printer. So the three truths to remember are that modern money is created as debt not value debt guarantees. Periodic collapse and crashes funnel wealth upward. And once you see this, you stop believing recessions are random storms and start recognizing them as predictable phases of the same machine, a machine that only works as long as people don't understand it. Which is why learning how money truly operates may be the most important defense you have before the next unexpected collapse arrives.